Do you know how much of your dividend income you get to keep after taxes in Canada? Let's uncover that. Hi, I'm Dave. I help Canadian business owners achieve their dream life with innovative financial advice. Dividend income is the money paid to shareholders by a company from its profits. As a business owner, you can earn dividend income by receiving dividends from companies you've invested in or by paying yourself dividends from your own company. When it comes to investing in publicly traded companies, dividends are a reward for owning shares. The amount of dividend you can receive may be a fixed amount per share or as a percentage of the share's current market price. Investors often see dividends as a sign of the company's financial health and stability, as it indicates consistent profitability by sharing earnings with shareholders. When it comes to paying yourself, you have the option to pay yourself a salary or a dividend. I will share several advantages and disadvantages of paying yourself a dividend from your company in Canada. Let's start with a few advantages. Number one, dividends can be a tax-efficient and flexible way to pay yourself. Dividends are taxed at a lower personal tax rate than employment income, and you have the flexibility to determine the timing and amount of dividends you receive, giving you greater control over your cash flow. Number two, unlike salary or bonuses, dividends are not subject to Canadian Pension Plan, CPP, or employment insurance EI contributions, allowing you to keep more in your pocket. For most business owners, we recommend you avoid paying into CPP. It will put control of your retirement in your hands instead of the hands of the government. Number three, dividends have asset protection benefits. Dividends generally cannot be seized in the event of personal financial difficulties. Now, there are some drawbacks to paying yourself dividends. Number one, dividends experience double taxation, once at the corporate level and again at the individual level. The company has already paid corporate taxes on its profits, and when the company pays dividends to shareholders, shareholders will get taxed as well. Number two, unlike salary payments, dividends are not deductible as a business expense for the company. If you're debating whether you should pay yourself a salary or dividends, click the I in the top right corner for a comparison of the two options. In Canada, dividend income is taxed at both the federal and provincial levels. The taxation of dividend income depends on two factors. Number one, your individual tax bracket, and number two, whether the dividends are classified as eligible or non-eligible. Let's break down the difference between eligible versus non-eligible dividends. Eligible dividends are issued by Canadian corporations that meet specific criteria, such as earning over $500,000 of active income in most provinces annually. With eligible dividends, the corporation pays a higher corporate tax rate on its profits, so when shareholders receive the dividends, they are taxed at a lower tax rate. This results in a higher dividend tax credit for shareholders. Non-eligible dividends are dividends paid by Canadian corporations that do not earn over $500,000 in active income annually in most provinces. These are typically smaller private corporations. The corporation pays a lower corporate tax rate, and as a result, shareholders are taxed at a higher personal tax rate compared to eligible dividends. Non-eligible dividends still receive a dividend tax credit, but at a lower rate than eligible dividends. When you pay yourself dividends from your own company, depending on how much your company earns annually, it will determine if your dividends are eligible or non-eligible. Ultimately, you must consider factors like tax implications, cash flow needs, long-term financial goals when determining dividend income. Having a financial planner on your team to identify any blind spots with decisions like these can be incredibly beneficial since everyone's financial picture and goals are different. Paying yourself dividends or gearing your investment portfolio towards dividend-producing investment vehicles may be suitable for some, but not for all. Thank you for watching. Hit the subscribe button and the bell icon to get notified when new content is uploaded. If you're interested in learning more, we have another video for you. Click here to take a look.